In 1975, a young farmer's life was almost over after taking out a farm loan. That same choice made him the most powerful man in his county 10 years later. This is the story of how time, debt, and patience determined who lived and who died when farming almost stopped. A young farmer named Daniel Mercer had a brand new row crop tractor sitting in his yard on a cold March morning in 1975. The dealer plates were still on it, it had a strong engine, a sealed cab that blocked out noise, and a price that seemed almost too good to be true. The loan papers said the total amount was just over $40,000, funded through an agricultural credit lender with interest rates close to 10%. Daniel was 32 years old and farmed for rent on about 800 acres of land in a rural Nebraska county. That one machine was worth more money than his dad had made in his 5 best years put together. Daniel was going around the tractor for the third time that morning in the farmhouse. His wife Laura stood quietly at the kitchen window and watched. It was the same things that were going through her mind that were going through his. They had just agreed to take on so much debt that it would take 6 good years to pay it off if grain prices stayed high and nothing went wrong. Daniel finally got in the taxi and turned the key. When the diesel engine turned on, it made a deep, steady rumble. It wasn't like the loud roar he remembered from his childhood on open trucks. It sounded calm, far away, and almost comforting. It felt smooth as the gears changed as he slid the transmission forward. As the machine moved forward, he realized what a risk he had just taken. The information below was put together from farm records, loan files, land transfers, and economic accounts from the next 10 years. There are made-up names and some personal details, but the financial pressures, market forces, and choices are based on real things that happened in farming across the Great Plains during one of the most unstable times in modern agricultural history. Daniel didn't start with the upper hand. In the late 1960s, when Daniel was still in his mid-20s, his father suddenly died. He had farmed 400 acres that he bought and rented from different people. His mother got the land, but she got married again a few years later and moved away. Daniel used a long-term land loan to pay off her share at a time when farmland was still pretty cheap. He was careful for a few years after that. He lived on very little money and rented extra land from a retired couple. He also used old machines that had been in use for a long time. During good years, he made about $12,000 a year. Not nearly as much in bad ones. He put away what he could, but in the early 1970s, everything changed. The old rules stopped working all of a sudden when global grain markets got tighter and energy prices went through the roof. Farmers had never seen crop prices go up so high, and land values went up even faster. Acres that were once seen as a burden on the balance sheet turned into investments that made it possible to borrow money. People in Daniel's neighborhood who had always had confidence issues suddenly gained it. He saw younger farmers take on huge farms and do well because the high prices covered up their mistakes. At extension meetings, there were lots of charts that showed how bigger farms could split costs and handle changes in the market. It was easy to understand. You had to get better to stay in the game. Daniel knew another thing as well. The info that lenders saw was the same. Credit was easier to get when land prices were going up and commodity prices were high. It was now worth a lot more than Daniel paid for the 400 acres he owned. Because he had property, it was easy for the lender to give him the money to buy the new tractor. It came early in the spring. Within a few weeks, another chance came up. A nearby farm with 800 acres and houses and tools that could be used went on the market. The owner wished to leave the business while prices were high. The numbers were scary, but Daniel could make it work if he used the value of his land as a down payment. There was a huge risk. He could lose everything if prices, fuel costs, or interest rates go down. Laura and Daniel sat at the kitchen table late at night and made up stories with pencil and paper. Laura didn't try to change his mind. She just told them that if they were going to take a chance, they should do it now, while lenders were sure they could get the loan and the terms were still fair. Later that year, Daniel bought the equipment because of his choice, and by harvest time, he was working 1,200 acres with tools that could handle the work. In the fall of that year, yields were high, prices stayed the same, and Daniel made more money than he ever thought possible. A lot of people think the story will end up being a simple one about easy growth and success. It didn't. Agribusiness started to go through wild swings over the next few years. As the government changed its policies to fight inflation, crop prices went down, fuel prices went up, and loan rates went up. Farmers who had taken out a lot of loans with rates that could change felt the pressure right away. When Daniel's loans were locked in earlier, they looked like a gift all of a sudden. He did the opposite of what he should have done and grew. He worked hard to get rid of his debt. Extra money was put toward the capital. By the late 1970s, he had gotten rid of short-term running loans and cut down on interest payments. When lenders offered Daniel attractive starting rates on adjustable-rate land loans, he turned them down. Instead, he picked higher fixed payments, which gave him more security even though it cost more in the short term. It took months for the oil markets to get back to normal, and interest rates shot up to levels that not many people thought were possible. Payroll went through the roof for farmers whose debts changed. Some activities fell apart because of the wait. Daniel's bills didn't change. Others were running around, but he stayed put. In the early 1980s, when land prices were at their highest and then fell, auctions became very frequent. People lost farms that they had worked on for generations. Daniel went to some sales, but most of the time he just watched and waited. When used tools went on sale for a small fraction of what it cost new, he paid cash for only the things he needed. He was ready to act when troubled land finally came up for sale at prices much lower than their peak. He bought a lot of land at the bottom of the market in the early 1980s, which doubled his land area again. The time and price made it work, even though it was risky. From there, momentum grew slowly instead of quickly. As markets steadied and interest rates slowly went down, Daniel refinanced in a smart way, made his business more efficient, and expanded his land holdings. Different types of soil made rain less likely. With fixed-rate loans, you could plan ahead. By the middle of the 1980s, his business was one of the biggest in the county. This wasn't because he went after every boom, but because he waited out the worst of the bust. During that 10 years, his equity gradually grew while others went away. The change did not happen without pain. There were breakdowns, bad weather, sleepless nights, and a lot of stress from having millions of dollars worth of responsibilities. But the framework he set up meant that the business could handle volatility instead of being destroyed by it. By the time he was in his early 40s, Daniel owned thousands of acres, had several full-time employees, and ran a modern fleet that was sized for efficiency rather than vanity. This story isn't about luck or being brave to learn something. It's about knowing when to act, being disciplined, and assessing risk. Daniel was willing to take risks when the return was good, to stay stable when others were betting, and to wait patiently when fear ruled the market. Patterns from that time are still useful today. The questions are the same, but the numbers and tools are bigger and more complicated. When should you grow and when should you wait? How should you set up your debt so that it doesn't destroy you when things change? Daniel bought a tractor in the spring of 1975, and it stayed on the farm for over 15 years. It worked for a very long time before it was finally traded in. In the end, it wasn't the newest or flashiest machine, but it stood for a choice that was made at the right time and on the right terms. That was much more important than horsepower or paint in the end. When you buy something, why you buy it, and how you build everything that comes after can make or break your success. Daniel often thought about how easily things could have gone the other way by the early 1990s. From the outside, the farm looked strong, but he knew that the edges had been very thin before. Everything would have been different if one bad choice had been made after another. What made him successful compared to those who failed wasn't just smarts or toughness. It meant holding back. He learned early on that growing did not mean always moving. While others rushed forward, sometimes it meant stopping and letting the ground settle before taking the next step. Over the years, the business continued to grow, but it did so more slowly and carefully. Daniel liked making deals with older landowners who wanted a steady income without having to handle their properties every day. These deals cut down on risk and stopped bidding wars that drove up prices. Instead of chasing acres at any cost, he put his money back into storage, drainage, and the health of the land. Long-term stability, not just next year's balance sheet, was used to judge every increase. The pressure never really went away. Things still happened based on the weather, markets could change quickly, and debt was always there. But the building stood. When interest rates went down, it became easier to handle fixed payments. Instead of being done out of pride, equipment improvements were timed to make money. Workers were seen as an investment, not a cost that needed to be cut. Each year, the farm became less vulnerable. This wasn't because there was less risk, but because it was handled in a planned way. Daniel also knew something that wasn't often shown in charts. People were hurt by expansion. Someone lost an acre for everyone he got. Each sale showed a family that had to make decisions they didn't want to make. He never had a party for those times. He just said that they were a part of a business cycle that was bigger than any one farmer. That knowledge changed how he did business and how he interacted with other people in the neighborhood. When we look back, the years between the mid-1970s and mid-1980s shaped everything that came after. Not because people were blindly optimistic, but because they carefully planned when to buy, how much to pay, and how to pay for it. Opportunity came from equity, but only because it was kept safe during the bad years. Debt helped the economy grow, but only because it was set up to handle changes. For people today who have to make similar choices, the story gives them a different point of view instead of a formula. Cycles don't go away, even though markets, laws, and technology change. Most of the time, farmers and businesses that last aren't the ones that avoid risk completely or chase it non-stop. There are some people who can tell when to be patient and when to take action. Daniel never said his road was simple or that it could be done again in exactly the same way. He knew that luck played a part. But he also knew that luck favors people who are lucky enough to live long enough to enjoy it. He didn't just make one brave move that led to the farm he built. It was the result of a number of choices that took into account timing, debt, and the fact that agriculture is prone to volatility. That's how things work. When Daniel got closer to 40, his goals started to change in small but important ways. The sense of urgency that used to drive all decisions has faded, and a longer view has taken its place. He was no longer satisfied with just land or cash sales as measures of success. More important was stability. Predictability was more important. He wanted a business that could handle sudden changes in the market as well as changes in his own life. A bad year, illness, or being sick shouldn't be able to undo decades of work. That way of thinking affected how he organized everything that came after. He still liked fixed responsibilities more than variable ones, even though they looked good on paper. He remembered too well how quickly being sure of himself could turn into being scared. He fought the urge to think that prices would stay high when they were high. When prices dropped, he didn't give up hope. Instead, he focused on cash flow and keeping costs low. With each turn it made it through, the farm became less reactive and more resilient. Daniel also thought more about who would take over when he died, even before he had a clear plan. He had seen too many farms fail when one generation left without planning ahead. The records were kept clean. Debt plans were easy to understand. The way the land was set up was written down in a way that made future changes possible, not chaos. When it was time to slow down, he wanted options, not to be forced. The people in his neighborhood kept changing. Smaller businesses shut down, were merged with bigger ones, or were sold off completely. Younger farms had problems that Daniel didn't have to deal with, like higher land prices and smaller profit margins. He knew how frustrated they were because he remembered how hard it was for him to get by in his early years with old tools and small profits. He tried to offer fair rental terms and clear deals as much as possible because he thought that building long-term relationships was more important than making as much money as possible in one season. Daniel always remembered how close he was to making the wrong choice at the wrong time. In hindsight, the line between growth and failure wasn't as clear as it seemed at the time. Being aware of that kept me from being cocky. Every good year was seen as short-term. It was thought that every problem could be handled. It wasn't that the farm was safe from weather, it was built to bend without breaking. As soon as he turned 50, The business no longer needed him to work 24 hours a day, 7 days a week. Set-up systems were in place. People were taught. Choices were made together. The farm wasn't always an emergency, it had turned into a business. In a way, that felt more like a win than the land or the tools. Daniel sometimes remembered that cold March morning in 1975, when he was standing in the yard with a tractor that seemed way too expensive for him as a young farmer with big dreams and rental land. It looked like the start of everything at the time. As it turned out, it was just the first in a long line of decisions that needed both courage and patience. In the end, the machine itself was changed. There were many changes in the markets. But the discipline he learned as a child stuck with him. Daniel's story wasn't really about beating the system or the market in the end. It was about being aware of and honoring cycles. It was about being aware of when to move and when to wait. It was also about making something that would last in a field where things change all the time.